What is up everyone, and welcome back to the channel. Today we're diving deep into order blocks. Now if you've been in trading for a while, you've probably heard of them, but today we're going to simplify it, break it down, and show you exactly how to use it and improve your trading with them. By the end of the video, you'll understand what order blocks are, how to spot them, and most importantly, how to use them to make better trades. So let's jump straight in. So what are order blocks? Well, simply put, order blocks are just zones on the chart where large institutional traders such as banks, hedge funds, and so on are placing big buy or sell orders. These orders are so massive that they can't all be executed at once, so they leave a sort of footprint on the chart. For us retail traders, it's like a trail that the big players are leaving behind. If we can spot these order blocks, we can potentially use them to predict the future price movements and take advantage of them. So there is two main types of order blocks, bullish and bearish order blocks. Bullish order blocks form when there are large players buying heavily. They act as support zones, so when price revisits them, buyers are likely to step in again and push the price higher. Bearish order blocks, on the other hand, are created when the big players are selling, acting as resistance zones. When the price returns to a bearish order block, sellers are likely to step in and push the price down. So how exactly do we identify these order blocks? Well, let's start off with a bearish order block. So to identify a bearish order block, let me just quickly move this here. To identify a bearish order block, we need two key things. First, we need a liquidity sweep, like we see here. Let me quickly mark it on. A liquidity sweep will be above the high, indicating that a lot of the shorts have been liquidated and that the stop losses have been hit. Then we will get a change of character here on the low. Now that we have the liquidity sweep and the change of character, we have our order block somewhere around in this area. Now the order block, I'll show you exactly how to find your entry point and so on later on, but this will be our order block in the bearish scenario. So this is our bearish order block. And you can see when the price revisits, it'll act as a resistance level to then fall back down. Now a bullish order block is quite similar. We also need a liquidity sweep, but this time it's a sweep of the low. Now we get the liquidity sweep of the low, indicating that all of the longs have been exited and that their stop losses have been hit. We need a change of character to the upside, such as here. Now that we have the change of character and the liquidity sweep, we're in an uptrend, and this right here is going to be our bullish order block, and you can see price revisits it and acts as a sort of support level to go up. Now we have high probability and low probability order blocks. Now obviously the higher probability order blocks are much better to trade, and you only really want to be trading the high probability order blocks. But again, they will occur less often than low probability order blocks. So how do we identify each one? The higher probability order blocks will usually have a larger body and smaller wick candles, whereas the lower probability order blocks will have larger wicks and smaller bodies. Now the way I identify an order block is by drawing a box from the top of the wick to the bottom of the wick and then drawing the box out. Now this would be my order block, and the same done for the low probability order blocks. But now you may be wondering, how do we find an entry when the candles are large and the price varies from the top to the bottom of the candle? Well, I like to use the Fibonacci tool. So what I do is I draw it from the top all the way down to the bottom, and then I use the 0.5 level on the Fibonacci. Now this will let us determine the 50% level of the order block. And I also do the same for the low probability order block as well. Once we get that, we're able to enter our trades off of this 0.5 area. Now we have three key tips for order blocks before we move into the examples. Tip number one is to always use multiple time frames, and always to remember that the higher the time frame, the more confluence there is that the order block will work. One way to increase the accuracy of your trades is just by using multiple time frames. For example, if you find a bullish order block on both the daily and the 1 hour chart, that's a strong confirmation that the zone is important and that it could work much more likely than if you only found it on like a 1 minute time frame. I like to look for confluences across multiple time frames just to make sure that the setup is valid and it is solid. Next up is to always look for the liquidity grabs. Sometimes the price will briefly break through an order block before reversing, and that is what is called a liquidity grab. Big institutions will do this to trigger stop losses, scoop up the liquidity, and then move the price in the direction they intended to. If you notice this, don't worry and don't panic. Sometimes it's just the big players shaking out the weaker hands before making their real move. And that is also why we use the 0.5 fib entry to help determine the 50% area, so we're not risking too much. Another one is also combining your confluences. So we made two previous videos right now on market phases and market structure. Make sure to watch them, and also make sure to use them as confluences in your trading. You don't want to be entering a bullish order block if the market phase is in a bearish trend. Now we have our first example of a high probability bearish order block. So here we can see we have a liquidity sweep up above right here. Then we start trending down and we get a change of character from this low. We break it, and this will be our order block. This is the candle that broke the change of, or that made the change of character. If you want to get even deeper, you can say it's this candle, but I like to use the range of candles as it just helps us get a more definite area. Then what we do is we get the Fibonacci tool and we draw it from the top to the bottom, and this will be our entry. So you can see once we got that change of character, we got our first retest, and if you were quick enough, you could have entered right here. Now again, if you weren't, it doesn't matter because we could have just placed it later on. We always want to put our stop loss above the high right there, and then our take profit at the low, or if you find other lows that you think are good and that you think can hit, you can always drag it down. Now you can see even after the first initial retest, we came down and we came back up, retested the order block. You can see we went slightly above, but as long as we don't break that high, the trade is still active. We hit the order block and then we went back down. Now one thing to always remember is that order blocks get weaker the more they get hit. You can see the first time it hit, it resisted it quite well. It didn't go that close to the high right here, but the second time it got a bit closer to the stop loss. Every time it gets weaker. Now the reason this is a high probability order block is because, as we talked about previously, the candle right here is a large body candle with smaller wicks. Now we have a low probability example. So here again, this is on the bullish side now. We can see that we get a liquidity sweep of the lows, and then after that we get this change of character right here with a candle close above the high. And this candle right here is our order block. Now the reason it's a lower probability order block is again because we have these larger wicks and smaller body, and you can actually see the effect of it being a lower probability order block, because previously on the high probability order block we actually came in on the 50% level and we hit it to move back down, but here you can see we didn't hit this 0.5 level at all. Instead we just bounced off of the top of the order block and carried on the move up. That is why I much rather prefer using the high probability order blocks rather than the low probability order blocks. Now if you want to trade effectively with order blocks, there's also 3 key tips. The first is the entry point. So always make sure, as we talked about, to use a precise entry point for your order blocks and not just a random guess. Because the order block can be a range, you don't want to guess the top, the bottom, or anywhere in between. What I like to do, again, is I like to use the 0.5 fib level, which allows us to determine 50% of the order block and enter from there. This allows our trade to be more precise and slightly more mathematical. The second is your stop loss. You always want to have your stop loss at the high or low. Again, depends if it's a bearish or bullish order block. If it's a bullish order block, you want to have your stop loss on the low, and if it's a bearish order block, you want to have the stop loss on the high. Finally, we have the take profit. For your take profit, you can set it next to the major support or resistance level, and you always want to make sure you're using a positive risk to reward ratio. That means if your stop loss is going to be $10, you need your take profit to be at least over $11. Now, if you did enjoy the video and it did help you out a lot, make sure to like and subscribe, as it does help out a lot. Also check out the Discord down below, because we have a lot of educational materials on all of our strategies in there, and we also have a lot of good trade alerts. If you also need any places to trade, such as exchanges and everything like that, you can check it out in the description also. Thank you all for watching, and I'll see you all in the next one next week. Goodbye guys.